All right, cool. So yeah, I have a speaker to come in that normally that's just their profession. You see what I'm saying? That'll help us out along the way, but that'll tell us all the nuggets. But man, 2020, man, it's time for us to know the stuff that we didn't know. You know, us don't know. You see what I'm saying? So with her coming in here with these budget plans and all this type of stuff, of course, yeah, you want to yarn to it, but it's stuff that's needed. It's stuff that we all need. How many times we didn't all live paycheck to paycheck, man? I'm sick of it. Living paycheck to paycheck, you know, but then if we had these budgets in action or we open up a business account. I remember when I started this agency 5 years ago. My first 2 years, I never had a business account. As soon as I opened my business account, I saw my funds start to increase. The same money I've been having, but I just separate that one piece of money, and you see your money grow. You see what I'm saying? So it's all about how you spending your money monthly. Okay? And what I'm going to talk about, my stuff.
I ain't did nothing.
Okay, all right, yeah. So here I am. Here's a couple things that I'm a trusted advisor. So I like to think of myself more than just an insurance agent. I'm a trusted advisor. I'm life and health licensed, of course. Securities. I have the SIE. I have my security 6 and 63, and I just recently started tax preparation. Okay, so those are my things that I bring to the table. All right, so I like to think of myself as a pillar of the community. So what I try to do is I just try to reach out to any community service events that are available in the state of Arkansas. Okay, I reach out to skills and drills training. I do an annual toy drive every year. It's my 4th annual toy drive. That's me at a school. That's me speaking to kids at a boys club. That's the toy drive again. So my thing is this, man. I do this stuff for free because I believe if I plead myself through the community, my community gives back. I made a status about that the other day. Give to your community and watch your community give back to you. Alright, cool. So I'm going to go right into it. Who all know the difference between whole life and term life insurance? Y'all know, everybody know the difference? Whole life insurance, term life? I know you know, Megan.
No, I might.
You forgot? Anybody you know? Come on, y'all. Alright, so whole life insurance is simple. It's for the duration of your whole life. Okay? It never goes away. You never have to renew this policy. It stays into effect until you die. And then they'll pay. Okay? Term life insurance, you get it for a term. So, say for instance, they'll put you on a 10-year term policy, 20-year term policy. You pay on it for that, and then you have to renew it kind of like auto insurance. Just renew your policy. Now, when you go back, it might be a little higher, might be a little cheaper. It's just the point of renewing the policy. Okay? You get more coverage for a cheaper price with a term policy. With whole life is steady. Okay? Pricing will change. All right, so the first policy, what I'm going to do is I'm going to talk about 3 different policies that you guys can get that it does more than just, it's more than just normal life insurance. So you just don't pay on it, you die, then they pay your beneficiary. It's more than that. First policy is a whole life advantage. Whole life advantage policy, I jump right into it. The riders, it has an accelerated death benefit. So that simply means that you get this policy and say, for instance, you get sick or to where you can't do your normal daily functions. You can't go to work, you can't wipe yourself, you know, that's when the waiver of premium will come in. That simply means it'll take away from something called cash value, which I'll get into a little later. Cash value, which accumulates in whole life policies, or from just paying monthly. They'll take away from your cash value and pay towards your premium. Okay? So you get laid off from your job a month or so, that's when they'll come in and take that from the loan and pay on your premium. So your policy will keep going. A couple good things about it: long-term protection, guaranteed death benefit, increasing cash value, which I just talked about. The good thing about this policy is, like I said, it's more than life insurance. So it has a 10, 20, and pay till 70, pay till 120, which is regardless. I mean, which is hard if you ask me, but you know, it has those options. So what I did was I gave, and then it got that one. Those are the ages that we can have, 0 through 80 in this policy. So what I did was I gave y'all a scenario. So I used my clicker roll. Alright, so I used my son, Kelvin Parker. He's 5 years old, right? So what I did was when Kelvin was, I really did this when he was young, but I did it, I'm gonna do it for 5. Say for instance, you got a 5-year-old child. You put this dude in a whole life advantage policy, $50,000 death benefit, you pay on it for 20 years. At the end of that 20 years, you're done paying on the policy. Okay? Okay? You done paying on the policy. He's 25 years old now. He has a life insurance policy just stuck in his pocket for his whole life. Okay? You done paying on the $52 a month. $52 a month. So you putting, it's basically you investing in your kids. You see what I'm saying? At that point of when he turns 25, you're done paying on it. A couple different things are going on. He has debt. He might be trying to go to college. He might be doing any of those things. Any of those things, he can use cash value at that point. At that point, he's 25. He can decide to cash surrender the policy and get the cash value that's been accumulating in the policy the whole time. He can use that towards some of the student loan. Okay? What you got?
So, you said you can cash the policy out, so is there any like fees or anything for that deduct you that $50,000?
So here's the thing. So it's like you borrowing from your own policy, if that makes sense. So the whole time that I showed on this next slide right here, all right, it's kind of blue. We got too many lights on, but it's kind of blurry, okay? But right, hit that light, see if they can see. Right, so say for instance you got that $100,000 life insurance policy. You pay him monthly, so it's accumulating cash value. Okay. Now by the time he's 20, and I already got it highlighted. By the time that guy's 20, he has about $50,000 worth of cash value in his policy. So my son at age 20, he has $50,000 that he can just take out of his policy. He doesn't have to keep the policy. That's one option. Okay, you can take it out, cash, surrender the policy, and there's no more. Okay, or he can borrow $20,000 off of it. He borrowed $20,000 off of it, and he died tomorrow. They only gonna pay $30,000. That makes sense. They only gonna pay what's the remaining of the policy. That's what that's for. Okay, I highlighted age 20 because he's done paying on it, and then I also highlighted age 60. By age 60, by age 60, it looks like he will have. It looks like $67,000. $67,000. What's up?
If you borrow from it, do you have to pay it back within a certain amount of time?
You don't have to, but if you don't pay it back, they'll take away from the death benefit.
So if you don't die,
What you mean if you don't die?
So I'm saying you're living on, you borrowed from it, and years are passed and you never have to pay it back because you borrowed from it.
It just takes away from the death benefit.
Okay.
Yep, just subtract from the death benefit. Yep. Any more questions about the whole life? What's up?
So who's the beneficiary?
Whoever you choose.
Okay.
I mean, if it's with Katie, it's me because I'm paying on it, but it can be whoever you choose. What's up?
Can he change that at any point?
As you have to make him the owner of the policy. So the owner that starts out will have to sign over ownership to him, and then he can make any
Does he
changes.
have to have your signature to retrieve money from the policy?
If he's
So
not the owner, yeah.
$20,000?
Only the owner can make changes to it.
Okay.
Only the owner. So at any time when he get 18, if you feel like he's responsible, yeah, sign it over to him. Sign it over to him. What else I got? We want? All right, cool. We'll go on. This clicker is what's up. I'll say lifetime UL. Couple good things about this policy: it's affordable, guaranteed protection, flexible premiums, and an exit strategy. You can cut them lights back on, please, brother. I'm sorry, I'm working him. Exit strategy. Riders on the policy. Couple riders on the policy. It has the child term. It has accelerated care rider, accidental death rider. Accidental death rider is, say for instance, you got that $100,000. I'm gonna keep using it. You got your $100,000. You can also add another $100,000 accidental death benefit to the policy. Okay, so if he dies, if you die any other way other than natural causes, it's an accidental death. Car wreck. What's going on, brother? Car wreck, anything like that. It's an accidental death. Okay. Continuing a payment rider. That's kind of like the waiver of premium, y'all. So if you're not able to pay your premium, that's when it'll kick in and take the loan out. All right, so I use my wife, Kelvin Parker. She's 28. I'm gonna put $250,000 death benefit on her. Okay, $20,000 term rider. So not only does she have insurance, her kids have insurance, and then here it has a $69.17 a month. Okay, so all that insurance for $69.17.
Question.
What's up?
So y'all both have policies, so if that was the case, y'all would both have two different policies on your children?
Yeah, you can have as many policies as you want. Yeah, there's no limit on life insurance policies that you can have. Now, when you get to getting too many, then it'll be kind of hard to get issued because they'll be like underwriting, be like, why are you study getting all these policies? You know, your child, you trying to kill them.
Right.
That's what they would think, but
Right.
yeah, you can get as many life insurance policies as possible as you want. Okay. So on this policy, you got to remember the first one was his own policy. This one is a child term rider. So not only does he have that $50,000, he got another $20,000. So he has $70,000. At 18, this $20,000 gonna go away because he's not a rider on the policy anymore.
So it just disappears?
Yeah, it's a term policy. See what I'm saying? So it's a term, meaning you can, at that point, you have to rewrite him another policy, like a renewal. You know, because he's coming off of your policy. You still got your $250,000, but he will come off of the child term rider. Okay, what you got?
And what kind of families, circumstances, or situation would you do that type of policy?
Lifetime UL, I think it's best for somebody that's in their 20s, someone that has kids, that they can get a child term rider. Or if you just want, like you said with her, you want to invest some money in the market, you want to see your money grow, you can use a policy like this. You can use a policy like this because it grows cash value as well. Yep. And then the good thing about this policy is, so say for instance, $69.17. You can overpay on your policy. So I got one of these too. Okay, I'm paying, my normal premium is like $50 a month, but I pay $99 a month. What I'm doing is that extra premium that you're paying is going into the market too. It's going into your cash value, monthly. So not only am I getting the normal cash, I'm doubling up. on it. I think I got it when I first got here. That was 5 years ago. I think right now I'm probably about 10 bands. Doubling up. So let your money make money for you. That's what I'm trying to teach you. Let your money make money for you. You gotta have life insurance anyways. So get something more than just life insurance. Get something that's gonna make some money on the side too. What you got? I saw you like your home, you was itching. What's up, baby?
So like, say it's like a single woman, like if she wasn't married to you,
Yeah.
can the child be the beneficiary and be a rider and get all of the monies of the way?
So anybody can be the beneficiary of the policy. But in that case, you'll have to have something called a contingent beneficiary. And a contingent beneficiary just simply means, how did you put it? You said,
I said could the child be a term rider and a beneficiary on the policy?
yeah.
Like
So say for instance, this $250,000 will go to the child if she was to pass. But you gotta have a contingent beneficiary, meaning that if the child, God forbid, was to pass before the mother, who else would he go to? You see what I'm saying? That's a contingent.
So the child can be both.
Yeah. He can be the beneficiary and get his $20,000. You see what I'm saying?
Okay.
He's a beneficiary of this $250,000.
Okay.
So that $20,000, what I would do is in this circumstance, I would make, say for instance, it's just her and him. I would make him the beneficiary of the policy and make her the contingent beneficiary, meaning that she would get the $20,000 if she was to, if he was to pass first. Yeah. That makes sense. What else? Y'all got something else? Go ahead.
I have a question.
What you got?
So is it best for both wife and husband to have two separate policies if they're both paying them?
I would.
Yeah, even because you know how much you can add your spouse to your policy.
You can. Yeah. Yeah.
So
You
would
can.
you
Any home
recommend-
life policy you can.
Would you recommend like if I were to have policy and add my husband and then you have separate?
Yes. Let me tell you why. Anytime you adding a spouse to your policy, it's a rider, just like the child term rider. So the thing about spouses, they normally stay on about age 65. So say for instance, you got that policy, and I put here as an extra rider for $100,000, and I add that on here. So if we get old, she turns 65, I gotta drop off. Now I'm sitting here at 65 with no life insurance. Now if I go apply, they're gonna bust my head. You know what I'm saying? Because the older you get, the more expensive life insurance is. So yeah, it's always good to get life insurance. Get your own policy too. And then I also want to mention this. It's also good. So you know how a lot of people be like, I got insurance on my job. I'm good. You know how people be having them $1 million policies on their job. As soon as you quit, or as soon as they let you go, that insurance gone. Gone. So these people spend, and I like to say this, like the people in the school district, they the best at it. You know, they get these things called group insurance. You have insurance agents like me, companies say it's group insurance. They'll give you like $1 million policy for $20, $30 a month. You thinking to yourself, man, I got a lot of insurance, I'm good. You with the school district 20 plus years. You retired, your insurance gone. Now you at the age of about 65, and once again, you have no coverage. You see what I'm saying? Now you out here trying to find final expense policy. You trying to get a little cheap $10,000 policy or $20,000 policy at your age, and you still gonna be paying about $60 to $70 a month.
So they still consider retirement as a form of.
It don't. If you're not working for them, they not paying life insurance. You lose all your benefits.
So
Health too.
I thought it just kind of just broke.
Only thing you have is a 401k investment. Now you can you gonna have a good little 401k. You can change that over into an annuity, or turn that into something else and try to make some money off that. But life insurance, you know, for real. And I try to preach that to people all the time. Like, you got life insurance on your job, cool. Get you a solid policy. So if someone comes in that got that term policy, I look more to sell them a whole life policy, something that's gonna stick around.